If you own physical metal right now, what I'm about to share with you could be the difference between protecting your wealth and watching it evaporate in the coming months. Because something extraordinary just happened in the precious metals market that most investors completely missed, and the implications are staggering. We just witnessed one of the sharpest corrections in gold and silver in recent memory, and while everyone's panicking, asking if this is the end, the smart money is doing something completely different. They're loading up, and I'm going to show you exactly why. Let me paint you a picture of what just unfolded. Gold, which had been climbing relentlessly, building momentum month after month, suddenly dropped in a matter of days. Silver followed suit, plunging even harder. The headlines screamed crash. Social media exploded with panic. Retail investors who bought at the top started dumping their positions, convinced they'd made a terrible mistake. But here's what nobody's telling you. This wasn't a crash, this was a shakeout. And if you understand what's really happening beneath the surface, you'll realize this might be the last major buying opportunity before precious metals enter a phase that could dwarf anything we've seen in the past 2 decades. Think about it this way. When you see a massive tree getting ready to grow, what happens first? The roots dig deeper. They consolidate. They gather strength. That's exactly what's happening in the gold and silver markets right now. The weak hands are being flushed out. The over-leveraged traders are getting liquidated. And the institutions, the central banks, the people who actually understand what's coming, they're accumulating at levels we haven't seen in years. Let me show you the data because this is where it gets really interesting. Central bank gold purchases have been absolutely relentless. We're not talking about small incremental buying. We're talking about systematic, aggressive accumulation by countries that are actively working to reduce their dependence on the US dollar. China, Russia, India, Turkey, Poland, these aren't random players. These are nations that understand the global monetary system is undergoing a fundamental transformation. They're not buying gold because they think it's going to go up 10 or 20%. They're buying gold because they know the current system is unsustainable, and when it breaks, gold will be the only asset that maintains its purchasing power. Now, before we go deeper into this, I want to make sure you have access to something that could be incredibly valuable for you. I've put together a free guide that shows the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's in the description below. This isn't some generic advice. It's specific strategies that are working in this exact environment. Grab it while it's still available, because what I'm about to reveal is going to make a lot more sense once you understand the full picture. Let's talk about what actually triggered this recent correction, because understanding the mechanics is crucial. The precious metals market isn't like the stock market. It's not driven purely by fundamentals or even sentiment. It's heavily influenced by the paper market, specifically the COMEX futures exchange. And what we just witnessed was a classic example of how concentrated short positions can temporarily overwhelm physical demand. Here's how it works. Large commercial banks, the ones with massive derivative books, can sell enormous quantities of paper gold and silver contracts. These aren't backed by physical metal. They're just contracts. But when they dump these contracts in size, especially during thin trading hours, they can trigger stop losses, force liquidations, and create a cascading effect that drives prices down rapidly. But here's the critical part. This only works temporarily, because while paper can be created out of thin air, physical metal cannot. And right now, the physical market is telling a completely different story than the paper market. Premiums on physical gold and silver coins and bars have remained elevated even as spot prices dropped. Delivery times from major dealers have extended. Refineries are running at capacity. The disconnect between paper and physical has never been more obvious. And historically, when this disconnect reaches extreme levels, something has to give. And it's never the physical market that breaks. It's always the paper market that eventually has to reconcile with reality. Let me give you a historical parallel that should send chills down your spine. In the late 1970s, gold went through multiple sharp corrections on its way to its peak. Each time, the mainstream media declared the gold bull market dead. Each time, retail investors panicked and sold. And each time, the smart money accumulated. Then gold went from around $200 an ounce to over $800 in a matter of months. The people who sold during the corrections missed the most explosive phase of the entire bull market. Now, I'm not saying we're going to see that exact pattern repeat, but I am saying the setup today is eerily similar. We have massive monetary expansion, geopolitical instability, a crisis of confidence in fiat currencies, and a physical supply situation that's becoming increasingly tight. Speaking of supply, let's talk about silver for a moment, because this is where things get really fascinating. Silver is unique among precious metals because it has massive industrial demand on top of its monetary demand. It's essential for solar panels, electric vehicles, electronics, medical applications. The list goes on. And here's the problem. We've been consuming more silver than we've been mining for years. The above-ground stockpiles that used to act as a buffer are being drawn down. And unlike gold, which is mostly recycled and stays in the monetary system, silver gets consumed. It gets used up in industrial applications and never comes back to the market. Now, combine that supply deficit with increasing investment demand. What do you think happens? You get a squeeze, and not just any squeeze. A squeeze in a market that's relatively small compared to other commodities. The entire silver market is tiny compared to the bond market, the stock market, even the gold market. It wouldn't take much capital flowing into silver to move the price dramatically. And when you look at the setup, with industrial demand accelerating, investment demand rising, and supply unable to keep pace, you start to understand why some analysts are calling silver the opportunity of the decade. But let's bring this back to gold, because gold is the anchor of this entire thesis. Gold is what central banks buy when they want to preserve wealth across generations. It's what sovereign nations accumulate when they're preparing for monetary system changes. And right now, the accumulation is happening at a pace that should alarm anyone paying attention. Think about what it means when countries that have historically held the majority of their reserves in U.S. treasuries start diversifying aggressively into gold. It means they see something coming. They see the debt levels, the deficit spending, the political dysfunction, and they're making a calculated decision that the risk of holding paper assets denominated in dollars is too high. And it's not just foreign central banks. Look at what's happening with gold ETFs. After a period of outflows, we're starting to see renewed interest from institutional investors. These aren't retail investors buying a few coins. These are pension funds, hedge funds, family offices, the kind of money that moves markets. And they're not buying because they're speculating on a quick trade. They're buying because their risk models are telling them that the probability of a major monetary event has increased significantly. They're buying insurance. And when institutions buy insurance, it's usually because they know something the general public doesn't. Let me share something with you that most people don't understand about gold. Gold doesn't go up because it's a good investment. Gold goes up because everything else is going down in real terms. When you see gold making new highs, it's not gold that's changing. It's the purchasing power of the currency it's being measured against that's declining. Gold is the constant. It's been a store of value for 5,000 years. It's survived every empire, every currency collapse, every financial crisis. And it will survive whatever comes next. The question isn't whether gold will preserve wealth. The question is whether you'll own enough of it when the preservation becomes necessary. Now, I want to address something that's probably on your mind. You're thinking, okay, this all sounds compelling, but what about the volatility? What about these corrections that wipe out gains? Here's the truth. Volatility is the price you pay for being early. If you wait until gold and silver are making headlines every single day, until your neighbors are talking about it, until it's the lead story on the evening news, you'll have missed the majority of the move. The real money is made by the people who understand the fundamentals, who can stomach the volatility, and who have the conviction to hold through the noise. Because that's what these corrections are. They're noise. They're temporary dislocations in a much larger trend that's being driven by forces far more powerful than any short-term trading action. Think about the debt situation for a moment. The United States is carrying debt levels that would have been unthinkable a generation ago. The interest payments alone are becoming one of the largest line items in the federal budget, and there's no political will to address it. Both parties are committed to spending programs that will only make the problem worse. So what are the options? You can raise taxes, But there's a limit to how much you can extract from the economy before you kill growth. You can cut spending, but that's political suicide. Or you can inflate the debt away. You can print money, keep interest rates artificially low, and slowly erode the purchasing power of the currency. Which option do you think they're going to choose? This is why gold matters, because when governments are faced with impossible choices, they always choose inflation. They always choose to debase the currency. It's the path of least resistance. It's the way to transfer wealth from savers to debtors, from the prudent to the reckless. And gold is the only asset that can't be debased. They can't print more of it. They can't create it with a keystroke. It exists in finite quantities, and that scarcity is what gives it value in a world of infinite monetary expansion. Let's talk about what's happening in the banking system, because this is another piece of the puzzle that most people are ignoring. We've seen bank failures, liquidity crises, emergency interventions by central banks, and each time the solution is the same. Print more money, expand the balance sheet, provide unlimited liquidity. But here's what they're not telling you. Every time they do this, they're undermining confidence in the system. They're proving that the system can't function without constant intervention. And smart investors are taking note. They're realizing that the safety they thought existed in traditional banking is an illusion. And they're moving capital into assets that exist outside the banking system, assets like gold and silver. Now, if you're sitting on retirement accounts worth $100,000 or more, this next part is especially important for you. I've put together a comprehensive guide on how gold IRAs work. It's in the description. This covers how you can get physical gold into your retirement account without triggering tax penalties. It's a strategy that more and more Americans are using to protect their retirement savings from the kind of monetary chaos we've been discussing. It's worth checking out if you're concerned about the long-term stability of paper assets. But let me get back to the bigger picture, because there's more you need to understand. The geopolitical situation is deteriorating in ways that should concern anyone with wealth to protect. We're seeing the formation of alternative trading blocs, countries moving away from dollar-based transactions, the development of alternative payment systems. This isn't speculation. This is happening right now. And every time a major economy reduces its dependence on the dollar, it reduces the demand for dollars globally. And when demand for dollars falls, the value of dollars falls. And when the value of dollars falls, the price of gold in dollar terms rises. It's not complicated. It's basic supply and demand applied to currencies. But there's another factor that's even more important: trust. The entire global monetary system is based on trust. Trust that central banks will act responsibly. Trust that governments will honor their obligations. Trust that the currency you're holding today will have similar purchasing power tomorrow. And that trust is eroding. You can see it in the polling data. You can see it in the behavior of institutional investors. You can see it in the actions of foreign governments. When trust breaks down, people flee to tangible assets. They flee to things that have intrinsic value. And there's no asset with a longer history of maintaining value through crisis than gold. Let me tell you about something that happened during the financial crisis that most people have forgotten. In the depths of the crisis, when banks were failing, when the stock market was in free fall, when panic was everywhere, gold held its value. In fact, gold was one of the few assets that emerged from that crisis at higher levels than where it started. The people who owned gold didn't just survive that crisis, they thrived. They had the liquidity to buy assets at distressed prices. They had the purchasing power to take advantage of opportunities that others couldn't access. And the same thing is going to happen in the next crisis, because there will be a next crisis. The only question is when. Now, let's talk about the technical picture. Because even if you're not a technical trader, understanding the chart patterns can give you insight into what's likely to happen next. Gold recently tested major support levels and held. That's significant. It means there's strong buying interest at these levels. It means the market has established a floor, and when you combine that technical support with the fundamental drivers we've been discussing, you get a setup that's extremely bullish. Silver showed even more dramatic support, bouncing hard off key levels. The volatility in silver is higher, which means the potential gains are higher, but so is the risk. That's why most advisors recommend a core position in gold with a smaller allocation to silver for those who can handle the volatility. But here's what really matters. The long-term trend is intact. Despite the recent correction, both gold and silver are still in strong uptrends when you zoom out and look at the bigger picture. These corrections are normal. They're healthy. They shake out the weak hands and set up the next leg higher. And if history is any guide, the next leg could be explosive. Because that's how precious metals bull markets work. They don't move in straight lines. They move in waves. And the biggest waves come after the sharpest corrections, when sentiment is at its worst, when everyone thinks the bull market is over. Think about the average investor right now. They're confused. They saw gold and silver rising. They heard the stories about inflation and monetary debasement. Maybe they bought a little bit. Then they saw the correction, they panicked, and they sold at a loss. Now they're sitting on the sidelines, convinced they made a mistake getting involved in precious metals at all. And that's exactly when the smart money is buying, because the smart money understands that the best opportunities come when sentiment is terrible, when prices are depressed, when everyone else is running for the exits. Let me give you another historical example. In 2008, gold dropped sharply during the initial phase of the financial crisis. Everyone thought the gold bull market was over. But what happened next? Gold went from around $700 an ounce to over $1,900 in less than 3 years. The people who sold during that correction missed one of the most spectacular runs in gold's history. And I believe we're setting up for something similar now. The fundamentals are even more compelling than they were in 2008. The debt levels are higher. The monetary expansion is more extreme. The geopolitical risks are greater. And the supply situation in silver is tighter than it's ever been. Now I want to address the elephant in the room. What about the argument that gold and silver are barbarous relics, that they have no place in a modern portfolio, that you should just own stocks and bonds and forget about precious metals? Here's my response. That argument works great until it doesn't. It works great in stable times, when currencies are sound, when governments are fiscally responsible, when the financial system is healthy. But we're not in those times. We're in a period of unprecedented monetary experimentation, where central banks are doing things that have never been tried before on this scale. And when you're in uncharted territory, you need insurance. You need assets that have proven themselves over centuries, not just decades. The reality is that every major fiat currency in history has eventually failed. Every single one. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created. And the pace of that decline is accelerating. The question isn't whether the dollar will continue to lose value. The question is how fast and what will you do to protect yourself? Because if you're holding all your wealth in dollar-denominated assets, you're making a bet that this time is different, that somehow we've figured out how to maintain a stable currency while running massive deficits and printing unlimited amounts of money. And history suggests that's a very bad bet. Let's talk about what happens next, because understanding the likely path forward is crucial for making informed decisions. In the short term, we could see continued volatility. The paper market manipulation could continue. There could be more shakeouts, more attempts to scare retail investors out of their positions. But the physical market fundamentals are only getting stronger. The supply deficits are real, the demand from central banks is real, the geopolitical drivers are real. And at some point, the paper market is going to have to reconcile with the physical market. And when that happens, the price moves could be breathtaking. Think about what a real supply squeeze would look like. Imagine if just a small percentage of the money sitting in bonds or stocks decided to move into physical precious metals. The market couldn't absorb that demand. Premiums would explode. Delivery times would extend to months. Prices would gap higher. And once that process starts, it feeds on itself. Higher prices attract more attention, which brings more buyers, which drives prices even higher. It's a reflexive process that can move much faster than most people expect. And the people who wait until that process is obvious will pay much higher prices than those who position themselves now. I want you to think about your own situation for a moment. How much of your wealth is in assets that depend on the stability of the financial system? How much is in banks, in stocks, in bonds, in retirement accounts that are denominated in dollars? And how much is in assets that exist outside that system, that can't be devalued by central bank policy? that have intrinsic value regardless of what happens to paper currencies? For most people, the answer is that they're dangerously overexposed to the system and dramatically underexposed to hard assets. And that's a risk that's becoming more acute with each passing month. The window for positioning yourself is closing, not because precious metals are going to disappear, but because the opportunity to buy at these levels might not last much longer. Every correction creates a window, and that window eventually closes. The smart money understands this. That's why they're buying aggressively right now, while prices are depressed, while sentiment is negative, while the average investor is too scared to act. They know that the best time to buy is when it feels uncomfortable, when the headlines are negative, when everyone else is selling. Let me share one more thing with you because I think this is important. Owning precious metals isn't just about making money. It's about preserving what you've already earned. It's about making sure that the wealth you've accumulated over a lifetime of work doesn't evaporate in a monetary crisis. It's about having options when others don't. It's about being able to sleep at night knowing that no matter what happens to the banking system, to the stock market, to the currency, you have assets that will maintain their value. That peace of mind is worth something. And for many people, it's worth more than any potential gains. Now, as we wrap this up, I want to make sure you take action on what we've discussed. First, grab that free guide in the description. It's packed with information that can help you make informed decisions about protecting your wealth. Second, if you're a retiree with at least $100,000 in retirement accounts, you qualify for an exclusive one-on-one educational web conference. It's completely free, no obligation, and it's only available to people who mention they watched this video. This is your chance to get personalized guidance on how to position your retirement savings for what's coming. The link is in the description. The bottom line is this. We're living through a period that will be studied by historians for generations. The decisions you make now about how to protect your wealth will determine whether you emerge from this period stronger or weaker. The precious metals market just gave you a gift in the form of this correction. It gave you a chance to buy at levels that might not be available much longer. The question is whether you'll have the courage to act while others are paralyzed by fear. Because that's what separates those who build lasting wealth from those who watch opportunities pass them by. The window is closing. The fundamentals have never been more compelling. And the time to act is now, before the next leg of this bull market leaves you behind.